So I think it was a close call, and the GDP data was particularly important because the Bank of Canada are a central bank that's very motivated by the output gap and where they think the output gap is. And I think the fact that we had that very strong GDP data is something they acknowledged themselves in the statement, saying the level of GDP is higher than they previously thought it was. So this was very much about the output gap rather than inflation.
So has it changed the RBC forward view on rates in Canada?
Yes, I think, after today's meeting, you really have to acknowledge that the Bank of Canada could be moving perhaps even one more time before the end of this year. Now, there's a lot of data between now and the October meeting. We'll have the Business Outlook survey, which the Bank of Canada are always very, very focused on, as well as another trade report, some CPI reports, jobs reports. So I think, we'll wait and see how the data pans out. But certainly our rate strategists will be looking at this very closely and thinking about when the next move will be.
And we have to talk about the next big risk event for FX traders as well, which is the upcoming ECB meeting. Mario Draghi basically shying away from talking policy and the euro at Jackson Hole. So what should we expect out of his latest meet?
So I think there's quite a widespread expectation that the ECB will try and talk down the currency. There have been some surveys pointing to that sort of expectation. And the risk, I think, is that the ECB doesn't say anything quite so formal, certainly not in the opening statement where it would have the most impact. Draghi is certainly going to be asked about it in the press conference, and I'm sure he'll say something along the lines of the currency does impact our inflation outlook. But if they don't actively talk down the currency, there is some very short-term risk that we do see a bit of a squeeze higher.